last but not least, Alison, you were going to talk about some options that are available after death that could achieve tax benefits and help charities.
Yeah, I'll do some numbers again in a minute, but before I come on to that, I think, I mean, obviously I'm talking to clients every day about their wills, and you're right, I do see a real swathe of people who do want to leave to charity, but you hear an awful lot of the time it'll get wasted on salaries, it'll get wasted on running costs, and that concerns them. Or they want it to be used locally, or they might not know exactly what they want it to be used for, and that's why I find a lot of clients are really interested to hear about the Community Foundation. And as an advisor, it's really helpful to know how the Community Foundation operates, because I can explain that a bit more to them. But I think also for anyone who's joined us today, if you don't know about the Community Foundation, find out obviously a bit more about it, but also Lisa and her team are really keen to get involved and talk to people, and always willing to meet with potential donors with no pressure, just to sort of explain how it works. And recently I've had clients, Lisa, you've met them, they've wanted to set up a fund in lifetime that they then want to top up through their wills at a later date. But what they really like is knowing during their lifetime they've got the ability to talk to you, talk to your colleagues, set down how it will work, and they've got that input into the parameters that fund will have, which I think people really welcome that opportunity. So I've said we talk about it during wills planning, but it's also something we always should raise with people when there's been a death and with the beneficiaries of the estate, because if there is tax to pay at the 40% rate, those beneficiaries might want to redirect some of the estate to capture the 36% rate. And we can still use deeds of variation at the moment, subject to the Office of Tax Simplification saying that they're a no-no. It's got to be done within the 2 years. But if the original will didn't meet that 10% baseline gift to charity, there's an opportunity to perhaps increase that slightly and get that lower rate. So here's another example for you. So pen and paper at the ready. Estate of 1.4 million this time, all general component, no lifetime gifts, so don't worry about those complications. But let's say this lady decided to leave 550,000 to her husband. She left a £35,000 gift to charity, and she leaves everything else to her daughter. So the inheritance tax at the moment is 1.4 million, take off spouse exemption of 550, take off the nil rate band of 325, and take off the charitable exemption of 35,000. So we've got 490,000 at 40%, £196,000 of tax to pay. Okay, we all get that. Our baseline is 525,000. So our legacy wasn't enough because it was 35. It didn't meet the 10% baseline. So the daughter says, all right, well, I'll give 53,000 to charity. We'll increase that from my share of the estate. So the charity is going to get more. We've now got the 10% going to charity, slightly more than 10%. So the estate gets the 36% rate of tax. The tax is now £169,920. Okay, so we had 525,000 of chargeable estate, take off the 53,000 going to charity. That's now at 36% instead of the 40% before. So if I do a comparison, the end result, husband still gets 550,000, his doesn't change. Charity gets 53,000 instead of 35,000, so it's getting 18k more. The revenue, boo, they get 169,920 instead of the 196 they were getting, so they're 26,000 and a bit worse off. The daughter ends up with £627,080 instead of £619,000, so she's better off. Ironically, she gets more by giving more to charity. Now, you'll have to run the numbers yourself if you don't trust me, but it's always worth having this conversation with the client, because as long as the original will gave 4% of the taxable estate to charity, somewhere between 4 and 10, by increasing it to 10, the residuary beneficiaries will always be better off. Okay? If you've got less than 4, they're not going to be. So if they're starting from nothing, they will be slightly worse off, but they'll have given more to charity and less to the taxman. So the magic number is 4%. Anything between 4 and 10, we increase it, and the residual beneficiaries will be better off. Wills can be drafted to include a formula. So we work out what's the formula of giving to charity to try and get that 10% rate. But actually, in my experience, it's not tax that drives people to give to charity. It is a bonus, it's an added benefit. But it's more about either benefiting a cause like everybody's talked about, something they're keen, they're passionate about. And I agree with something that both Catherine and Chris said. You get to know your client a lot better if you're having those much more personal conversations. It forges the relationship much better because you're interested in them and you're not just an advisor. You're really interested in them personally and finding out what makes them tick. So I think that's a real benefit for us as advisors. But what clients like is a legacy, and using the word as Catherine used it earlier, it's leaving a legacy behind them, not a cash legacy, but you know, they are making a difference, and perhaps that's why they want to set up their own fund, or it might just be that they want to give to another charity, but that they're giving sufficient that it's going to make a real difference to that charity. And I think that's the main motivator why I still see people giving to charity.